Let's discuss refinance analysis. And I'm going to talk about refinance analysis in Texas, but it's applicable for all loans all across the country. And I'll tell you right now, the competition is doing it wrong. They are doing it wrong. They're doing the homeowner an injustice by not doing the proper math. Here's what I mean. And by the way, there's a lot of reasons to refinance. A lot of them are need based, like cash out, home equity loans, pool loans, home improvement loans, debt consolidation, removing somebody from title because he got divorced. Like there's a lot of need based loans. Like you're doing that for a purpose to achieve something. What I'm talking about today is the refinance analysis for a rate and term refinance, meaning the sole purpose of why this refinance is going to happen is because the homeowner is interested in saving money. They're going to either improve their financial position by lowering the interest rate or the interest cost, and or removing maybe mortgage insurance, and or shortening the term of the mortgage itself, right? So that they pay less interest over time. So again, a rate and term refinance means we're doing something to the rate or the term to improve the financial situation of the homeowner. That's what I'm talking about. So here's how the industry as a whole typically does this math, and it's incorrect in my opinion. And I think you'll agree with me. And it's actually fact, they're incorrect. I understand why they do it because what I'm about to show you is a simple way. And so it makes sense, but it's not the right way. It's not the correct way, the accurate way to do this. So let's say you want to refinance your home. You call a generic mortgage company and they tell you, hey, congratulations. We can save you $300 a month on your mortgage. And so that's $3,600 a year. And this refinance is going to cost you $4,000 to do it. So the cost is 4 grand. The air quote savings is $300 a month or $3,600 a year. You should absolutely do this. Let's go. That's the speech and script and promotion because they're going to say you get your money back in just over a year, right? So it's technically be a year, 14 months basically, that you would recoup the 4 grand you just paid in fees after 14 months. Here's where that's inaccurate. Yes, the $300 a month feels good. If that lowers your monthly obligation, that's fine. If that's the goal and objective, fine. Because that there is an instance where folks just need some cash flow. That is fine, but that's not necessarily the rate and term piece. We're not there. It's not necessarily saving that $300. And here's why. Let's say in this example, somebody's been in the home for 5 years. Well, if they've been in the home for 5 years, what they may be looking at now is a 30-year mortgage, doing another 30-year mortgage. So they're resetting the clock. And so now they're adding, again, a longer duration of paying interest. So what really needs to happen is at this moment, whenever you're ready, the homeowner is ready to decide to do something, there should be a calculation done that says, okay, from this moment forward, and here's what I recommend, and here's what we do on the Mortgage Mark team. We say, okay, from this moment for the next 5 years, how much interest is going to be paid? And by not only interest, but also mortgage insurance, PMI, MIP, whatever you want to call it. So what mortgage insurance, PMI, MIP, whatever it is, plus the interest, what's going to be paid over the next 5 years. We then take that divided by 5 so that we get an annual number that says, the average of that says this many dollars is going to be paid over the next 5 years in interest and mortgage insurance. Okay. So once we have that number, we then say, okay, if we go get new loan over here, new loan for the next 5 years, what is the cost of the interest and the mortgage insurance? Same math, just different loan. So now what we can say is cool. Current loan has over the next 5 years, we're going to say is I don't even know a good number to use. Let's just say it's 20 grand, right? They're going to pay 20 grand in interest. And I don't know if that's high or low. I'm just trying to get something for conversation here. But let's say it's $20,000 of interest and mortgage insurance, whatever, over the next 5 years on the current loan. So divide by 5, that means 4 grand a year that they're going to be paying in the interest and mortgage insurance. Now, new loan, if we do the same math, whatever that comes out to be, and they're going to save, let's say they're going to save 2 grand a year. So the same math. So instead of costing $20,000 over 5 years, it would cost $10,000 over that 5 year period. So in other words, they're going to save that 10 grand over 5 years, or in this case, 2 grand. So all of a sudden now, the stay with the current loan costs 4 grand. Stay with the new loan is 2 grand. It's 2 grand a year. And so that really equates to $167 a month of savings. So even though this $300 a month, air quote, savings feels good and looks good, the reality is the interest and the mortgage insurance, the actual cost, the expense is only $167 saved in this example. So if you say it costs 4 grand to do it, and this is where I got to use the calculator real quick. If it's 4 grand of fees to get that done, the actual savings is 167. That's 24 months. Still great. Like I'm glad somebody's getting their money back that quickly. But oftentimes that 24 months, it may be 70 months, in which case you're like, well, I don't know if I want to wait 5.5 years. So just make sure you or your mortgage lender is doing the math correctly to determine the refinance analysis to make sure it's done correctly. And that's the biggest mistake people make. And so if you're not sure how to do it, because it's a lot of work, we have the ability to do it with tools on the Mortgage Mark team, something I created many, 15, 20 years ago. So we have a tool that we can plug it in. So what I need to know, if you want us to do that, I'll put a link somewhere down here for a form, and it's what is your current rate, what's your current balance, when did you get the loan? Like give us all the details that we can then recreate your current loan and then also calculate an estimated cost. And we can do this numbers for you because I'm telling you, the competition isn't doing it. They're using that simple math and it's plays to their advantage because it looks like somebody's saving all this money, but the reality is it's not true savings. So do the math right. Don't fall victim. Don't, this is probably one of my biggest pet peeves in the mortgage industry is how often, and it's the vast majority that I'm aware of, the vast majority of lenders do it this way, the wrong way. So let's do it the right way. Let's make sure it's accurate. Please reach out to the Mortgage Mark team. And again, there's a form somewhere. If you put that information in, we'll knock it out, get those numbers to you, come back to you and just we'll tell you straight up whether it makes sense or not. Because at that point, you and I, or I say you and I, but the team, right? The Mortgage Mark team, if we do that, we then get to determine whether or not you want to actually like move forward and do this if it makes financial sense for you. So let us know if you have any questions. We are here to help. As always, thank you for watching. And when you think mortgage, think Mark.